Stop what you're doing, close the other tabs. Because what I'm about to walk you through isn't speculation, it's a scheduled execution. This Friday morning, 72 hours from now, $14 billion in precious metals selling pressure hits the market with the force of a freight train. $7 billion in gold. $7 billion in silver. 5 days of nonstop liquidation. And here's what should concern you. This isn't panic selling. This isn't retail capitulation. This is forced liquidation, the kind that doesn't care what you think, what the market wants, or what the technicals say. It's happening regardless, because the mathematics demand it. The Bloomberg Commodity Index BCOM must rebalance. Not because they want to, not because they think prices are headed down, but because the rules require it. Silver's run has been too strong, too fast, and now they're overweight. The portfolio rebalancing pressure from silver's outsized position forces their hand. And there's only one way to fix it. Sell. Sell $7 billion worth of silver across exactly 5 trading days. Scotiabank, one of the largest precious metals desks in the world, published an internal report. I've seen it. The numbers are sobering. 17% of silver's total open interest is about to be pushed into the market. Let me repeat that for clarity. 1/5 of the entire silver futures market is about to absorb forced selling over 5 days. But here's what Scotia doesn't tell you. What most analysts completely miss. What might be the most important part of this entire story. The paper market and the physical market are about to divorce. They're about to decouple entirely. And if you don't understand this distinction, if you don't understand why one will collapse while the other holds firm, this Friday could be the biggest financial miscalculation of your investing career. Or it could be your last chance to acquire silver at 2-digit prices before it permanently enters triple-digit territory. The clock is ticking. You have 72 hours to decide which side of history you want to be on. Before we dig into what's actually happening, I need you to understand that what I'm about to share isn't sensationalism. These aren't wild predictions or conspiracy theories. This is strategic economic analysis based on real data, real internal reports, and confirmed events about to unfold. The kind of information your broker will never give you because they don't want you to know. The kind of information large financial institutions keep to themselves. The kind that can make or break 7-figure portfolios. If you value this kind of straight analysis, subscribe now. Not for me, for yourself. Because the next 72 hours could reshape your entire financial position. Now, let's talk about what $14 billion in forced selling actually means. Because most people hear that number and don't really grasp the scale of disruption it represents. Let me take you inside the room where this decision gets made, so you understand exactly why this is unavoidable and why it's going to be brutal. The mechanics of the inevitable. Wednesday evening, the silver market stood at a historical crossroads. Traders worldwide were glued to screens with an intensity I haven't seen in 20 years of watching this market. Silver had just touched $82.75 within pennies of its all-time high. The kind of price that generates headlines. The kind that brings new investors rushing in, afraid of missing out. The kind where people start calling their friends asking, "Should I buy silver?" Then something shifted. By Thursday's close, silver had pulled back to $78, a 6% correction in hours. Most analysts on CNBC, Bloomberg, all the mainstream commentators said the same thing. Just normal profit-taking. Healthy consolidation in a bull market. Nothing to worry about. They were wrong. Completely wrong. Because this wasn't just profit-taking. Something much larger, much more dangerous, was preparing to unfold. And very few people, I'm talking about a small circle of professional traders, hedge fund managers, people with access to internal information, only they understood the actual mechanism behind what's coming. Deep inside Scotiabank's trading division, one of the most influential institutions in the precious metals market, analysts had been running calculations for weeks. They weren't just looking at price charts. They weren't just analyzing technical indicators. They were tracking something most retail investors have never even heard of. The Bloomberg Commodity Index, what trading professionals call BCOM. And their findings? They were sobering enough that I had to read the report 3 times to make sure I wasn't misunderstanding. BCOM is an index tracking a basket of commodities, energy, metals, agriculture. Billions of dollars are invested in index funds that track BCOM. And there's a fundamental rule governing how these index funds operate. They must maintain specific allocation percentages for each commodity. When one commodity rises significantly like silver has over the past year, that allocation becomes too heavy. The portfolio falls out of balance. And when that happens, the rule is crystal clear. You must rebalance. You must sell down the commodity that's risen too much to bring the allocation back to target levels. This isn't a choice. This isn't a strategic decision. This is portfolio rebalancing pressure from silver's outsized weight. The formulas don't negotiate. The algorithms have no emotion. Scotia's report laid out the numbers with the precision of a death sentence. $7.1 billion in silver must be sold. $7 billion in gold must be sold. Total of $14 billion in notional selling pressure dumped into the market across exactly 5 trading days. The selling starts immediately after Friday's close. But the real impact, the real shock, hits Friday morning when global markets open and the sell orders start flooding in. For silver specifically, these numbers aren't just large, they're genuinely frightening. This forced selling represents approximately 17% of the entire open interest in March silver futures contracts. Let me repeat that so you grasp the full insanity of it. 1/5 of the entire silver futures market. All the buy orders, all the sell orders. Every open position is about to face concentrated selling pressure over 5 days. This isn't gentle rebalancing. This isn't minor adjustment. This is a structural liquidation event, the kind that market veterans with 30-40 years of experience tell me they've never seen at this scale. The critical distinction: discretionary versus non-discretionary. Now here's what's critically important for you to understand, because if you miss this point, you won't grasp why Friday is uniquely dangerous. There are 2 completely different types of selling in financial markets, and the difference between them is the line between survival and destruction for traders. The first type is discretionary selling. This is when traders make decisions based on analysis. They look at charts. They see RSI overbought. They see price hitting major resistance. They read the news and decide the market has priced in enough good news, so they sell. But if price starts rallying again, if the trend stays strong, they can change their minds. They can wait. They can buy back in. This is thoughtful, strategic selling. The second type is non-discretionary selling. And this is exactly what's about to happen Friday. Index rebalancing is structural, algorithmic, and completely emotionless. The traders executing these orders, they're not looking at chart patterns. They don't care about support or resistance levels. They're not checking Twitter to see what analysts are saying. They're simply following instructions. Sell $7.1 billion in silver. Execute over 5 days. Complete rebalancing. Done. Whether silver is at $70 or $80 or $90 irrelevant, whether the market is rallying or falling doesn't matter, whether there's breaking news about war or peace not their concern. The sell order still executes because the mathematics require it. And here's why, listen carefully, because this is probably the most important thing I'll say in this entire analysis. Here's why this event cannot be priced in, even though everyone knows it's coming. Normally, in an efficient market, when everyone knows an event is coming, the market adjusts price before the event happens. If everyone knows a company will report terrible earnings on Friday, the stock falls Wednesday and Thursday as investors sell ahead. By the time the actual earnings report drops, the news is already priced in. But forced selling doesn't work that way. It can't work that way, because the sellers aren't making strategic decisions based on future prices. They're simply meeting allocation targets and balancing books. The formula says, you need to hold 3.2% silver in the portfolio. Currently, they hold 4.1%. So they must sell enough to get back to 3.2%. That means $7.1 billion must be sold clean. The seller doesn't care if price is falling. They still have to sell. The seller doesn't care if it creates additional downward pressure. They still have to sell. That's why forced selling events typically create overshoots, declines that go far beyond what fundamentals justify, because the selling pressure doesn't stop when price becomes attractive. It only stops when it's complete. The rumor mill starts turning. By Wednesday evening, rumors had started spreading through the financial system like a virus. Trading forums filled with speculation. Telegram groups of professional traders buzzed with discussion. And then an article appeared on Zero Hedge, one of the few financial outlets willing to report what's actually happening, with the headline, "Is silver about to collapse?" But it was behind a paywall. Investors without premium accounts scrambled for information elsewhere. Reddit exploded with posts. Twitter filled with speculation. Details leaked out piece by piece. And experienced traders, those who understood the real implications of what was coming, started repositioning their portfolios. Some prepared to sell ahead of the wave, hoping to exit before the storm hit. Others sat waiting with cash, like vultures circling carrion, ready to buy any sharp dip that appeared. But here's what most of them completely missed. The most important detail buried in the pile of technical analysis: lost in the sea of charts and indicators. And that detail, this small but critically important detail, is the key to understanding why Friday might not play out the way everyone's predicting. BCOM doesn't hold physical silver. They don't have bars stacked in vaults. They don't store coins in safes. They don't own actual metal secured in storage facilities. Instead, they hold derivatives. They hold paper contracts. They hold futures positions. They hold ETF certificates. They hold financial instruments that track silver's price but aren't actually silver. And this distinction, this widening gap between paper and physical, is about to become extremely, extremely important. More important than most investors can imagine. When two markets tell different stories, because while BCOM prepares to dump $14 billion in paper into the market, the physical market, the market for actual silver metal, silver you can hold in your hand, is telling a completely different story. A story of scarcity, a story of shortage, a story of delivery times continuously extending, a story of premiums refusing to compress regardless of what paper price does. And this is where the story gets truly dramatic. The stage is set for Friday. But the real drama, the actual market disruption that could reshape the silver market for years to come, won't happen in the paper market. It will happen in the space between two worlds, the world of paper derivatives and the world of actual physical metal. The question nobody's asking, the question everyone should be asking is, what happens when these two worlds diverge completely? What happens when paper price says one thing, but physical reality says something entirely opposite? Let me show you. Marcus Chen's discovery. Marcus Chen had traded precious metals for 17 years. He considered himself an expert. He'd made and lost millions. He'd survived the 2008 financial crisis. He'd traded through the 2011 spike when silver touched $49. He thought he understood the silver market better than 99% of people. Until Thursday night, when reality proved him horrifically wrong. At 11:47 p.m., Marcus sat in his home office in Toronto, sipping his third cold coffee of the day, eyes red from staring at screens too long. He was preparing for Friday. He wanted to be ready for the storm. He was scanning online inventory from major dealers, checking prices, comparing premiums, looking for opportunities. And what he discovered wasn't just surprising, it was completely illogical, inexplicable. BCOM was about to dump $7 billion in silver into the market. Every pricing model, every technical analysis, every economist he followed said the same thing. Price will collapse Friday morning, maybe down to $70, maybe $65. Some extremists even said possibly $60. The logic was simple. Massive selling pressure equals sharp price decline. Economics 101. Basic supply and demand. So Marcus planned to wait, let the drop happen, then buy when price bottomed. That was the plan. But when he clicked through to SD Bullion's website, one of the largest precious metals dealers in North America, the product page loaded slowly, as if their servers were overwhelmed. And then he saw it. The screen filled with red labels. Out of stock. He scrolled down. Same story. The few remaining bars listed as pre-order, delivery, February 13th. He checked the date. This was January 9th. A 5-week delay for an item supposedly about to collapse in price. Chen switched to ApeMex, then JM Bullion, then Money Metals. The pattern repeated everywhere. 0.999 fine silver, the standard for futures delivery. The exact type BCOM would be selling in paper form was virtually unavailable in physical form. And where it was available, the premiums told an extraordinary story. A 100-ounce silver bar normally trades close to spot price, maybe $1 to $2 fabrication premium. Dealers were charging $85 per ounce. With silver spot at $78, that's a $7 spread, nearly 9% premium on a product that should track spot closely. This is where most investors get confused. They hear silver price and think it's one unified thing, one unified market. But it's not. There are actually two silver markets operating simultaneously, connected but not identical. And right now, they're diverging. The paper market trades derivatives, contracts representing silver, promises to deliver silver but not actual metal. When BCOM sells $7 billion in silver, they're selling electronic entries in computer systems. No trucks need to move, no vaults need to open. It's pure financial engineering. The physical market operates entirely differently. Actual silver bars must be cast at refineries. Actual coins must be struck at mints. Real metal must be transported in armored vehicles, stored in real vaults, insured and secured. And right now, the physical pipeline is stretched to breaking. Refineries are running 24/7 shifts, melting down 90% junk silver, pre-1965 US dimes, quarters, half dollars, to turn it into 0.999 pure bars. But they can't keep up with demand. Mints are rationing allocations to dealers. Dealers are implementing purchase limits, and delivery times keep extending. Chen immediately grasped the implication. When paper silver collapses Friday morning, when that $7 billion in derivatives floods out, physical dealers won't drop their prices correspondingly because they can't source more inventory. Instead, something paradoxical will happen. Premiums will widen. If spot price drops from $78 to $70, dealers won't sell 100-ounce bars at $70. They'll sell at $78 or $80 to prevent their inventory from being wiped out in a stampede they can't fulfill. The premium simply expands from $7 to $15. The physical market insulates itself from the paper market collapse. This creates a strange paradox. Physical silver holders watching their portfolio spreadsheets might panic as spot price drops 10%, but the actual value of the metal they hold barely changes. Try walking into a coin shop with a tube of silver eagles and demanding to sell at spot minus 10%. The owner will laugh in your face. He can't replace that inventory. His wholesaler is already backordered 5 weeks. He'll pay you close to what he paid last week, regardless of what paper silver futures are doing. Chen noticed something else interesting. Constitutional silver, 90%. The old coins were trading differently than pure silver. He found Mercury dimes, Washington quarters at exactly spot price, no premium. This made sense because you can't deliver 90% silver for future settlement. It's not pure enough. The Shanghai Exchange or COMEX won't accept it. It needs refining first, and refineries are swamped. So constitutional silver becomes the orphan, trading at spot, while 0.999 products get bid to the moon. For smart stackers, this is the opportunity. If paper silver drops to $70 Friday and constitutional silver follows, but 0.999 bars stay at $85, then 90% silver is the buy of the year. Eventually, refineries catch up, the 90% gets melted into 0.999 bars, and suddenly your $70 purchase contains $85 worth of refined silver. Chen started calculating his order. How many bags of quarters could he buy if Friday morning delivered the drop everyone expected? But the bigger picture worried him. This disconnect between paper and physical can't last forever. At some point, one of two things happens. Either physical premiums collapse back to normal, unlikely given tight supply, or paper price must rise to match physical reality, meaning current spot price is being artificially suppressed. Chen looked back at the screen. Paper silver at $78, actual physical silver at $85, a $7 gap that shouldn't exist in a normally functioning market. And Friday's forced selling is about to test that gap. Will it widen further, or will something break? The geopolitical backdrop nobody's pricing in. Captain Jennifer Holbrook stood on the deck of the USS Porter, watching through binoculars as her crew boarded a Russian oil tanker. They'd been pursuing this vessel, the Artemis, flying Russian colors, carrying Venezuelan crude, heading somewhere it wasn't supposed to for 3 weeks. Now, 200 miles off the Atlantic coast, American sailors were taking control of a foreign-flagged merchant vessel in international waters, what international maritime lawyers would call a significant precedent. Holbrook lowered the binoculars. She wasn't thinking about the silver market. But she should have been. Because 8,000 miles away, in a trading room in Geneva, Alexander Russo was thinking about exactly that. Russo managed a $2 billion commodities fund, and he'd just watched the tanker seizure flash across Reuters. His immediate thought wasn't about oil, it was about safe havens. Pull up gold charts, he told his assistant, then cross-reference against past military escalations. The pattern was unmistakable. Every time geopolitical tension crossed a threshold, every time international norms got violated, capital flowed into precious metals. Not immediately, but inevitably. The tanker seizure didn't happen in isolation. That morning, Iran's chief of staff had issued warning statements about preemptive strikes targeting U.S. positions in the region. These threats usually amounted to nothing, except when they didn't. Russo had watched this movie before. Act 1 is economic pressure and sanctions. Act 2 is inflammatory rhetoric. Act 3 is limited military intervention. Act 4 is temporary de-escalation. But lately, Act 4 wasn't happening. De-escalation windows were getting shorter, temperatures were rising, and eventually, something would ignite that couldn't be extinguished. He opened another chart that few analysts discuss, the oil-to-silver ratio. Currently, 1 ounce of silver costs $78. 1 barrel of WTI crude cost $56. Silver was more expensive than oil. This was historically unusual. Russo asked, "When was the last time this happened?" His assistant scanned decades of data, early 1980s and briefly in 2011. What happened next? Oil caught up dramatically. Russo nodded slowly. Everyone was focused on whether silver would collapse. Nobody was asking whether oil might explode. If Iran and Israel actually engaged not through proxies or limited skirmishes, but full regional conflict, the Strait of Hormuz could close. 20% of global oil supply disappears overnight. WTI wouldn't stay at $56. It would hit 80, 90, or higher. And industrial silver demand, which everyone assumed would drop in recession, was actually quite inelastic. Solar panel factories don't shut down. AI data center construction doesn't stop. EV production might slow but doesn't halt. Silver had become critical infrastructure, and infrastructure spending tends to be recession-resistant, especially when governments are desperate to stimulate. Russo switched to Federal Reserve data. The numbers were almost comical if they weren't so serious. U.S. national debt, $38.58 trillion, and accelerating. Debt to GDP ratios had crossed levels that historically trigger currency crises in smaller nations. But America isn't a smaller nation, it's the reserve currency issuer, which means they can print and print and print until the music stops. That morning, the Labor Department had released new data. Job openings in November fell to their lowest level in 13 months. The economy was cooling exactly as the Fed intended. Except they had a problem. Cool too much and you cause recession. But you can't let recession happen, not with this debt load, not with this political environment. So what do? You cut rates. You stimulate. You print money. Russo opened the CME Fed Watch tool. It showed market expectations for interest rates. Currently, rates sat at 3.50 to 3.75%. The market was pricing in 2 rate cuts this year, totaling 0.5%, bringing it to 3.0 to 3.25% by December 2026. Russo laughed aloud. 2 cuts? They think 2 is enough? He started drafting notes for his quarterly investor letter. The Fed will cut at least 4 times, possibly 5 or 6, because economic data will continue deteriorating, because geopolitical instability demands stimulus, and because the Treasury market needs support. The Fed had announced Treasury purchases starting in December, quantitative easing under a different name. They'd call it technical operations, liquidity management, but everyone knew what it actually was: debt monetization, printing money to buy government bonds. And once you start, you can't stop. Because stopping means yields spike, and spiking yields on $38 trillion in debt means fiscal catastrophe. Russo calculated quickly. Current silver price $78, market expectations only 2 cuts. If he was right about 5 or 6 cuts, and if each cut historically increased pressure on inflation hedge assets, then silver at $78 was pricing in less than half the monetary expansion coming. Gold at $4,400 was similarly mispriced. The market was looking at Friday's forced selling and missing the forest for the trees. His phone buzzed. Text from his assistant. Iran just moved 3 destroyer groups toward the Strait. U.S. Fifth Fleet shadowing. Russo looked back at the screen. Silver consolidating in a triangle pattern. Oil at $56. Gold holding $4,400. Everyone focused on Friday's rebalancing. Nobody calculating what happens if the Strait closes, if oil doubles, if the Fed cuts 6 times, if de-dollarization accelerates, if China moves on Taiwan while America's distracted. He opened his trading platform, began drafting buy orders. Not for Friday morning, but for the aftermath, for the recovery, for the moment when the market realizes that a $7 billion paper dump is nothing compared to the forces building beneath the surface. Russo had traded commodities for 23 years. He'd seen crashes and explosions, but this time felt different. Too many pressure points converging simultaneously. And macroeconomic reality would eventually refuse to be ignored. The 40-year pattern completing. Dr. Sarah Mitchell had studied precious metals charts for 32 years. She remembered when silver touched $50 in 1980, when she was just starting her doctoral dissertation in economics at MIT. Everyone said it would never return to those levels. They were right, for 40 years. But now, sitting in her Manhattan office, looking at the Bloomberg terminal, she was seeing something she never thought she'd witness. A pattern forming over 4 decades was entering its completion phase. She zoomed the silver chart all the way back to 1980, peak at $50, then collapse, then decades of sideways drift, bottom around $4 in early 2000s. Then, the 2011 spike to $49, crash again, another decade of accumulation. But when you connected the lows, when you traced the arc of those bottoms, you saw something extraordinary. A cup. A massive cup pattern spanning 4 decades. And in 2024, silver finally broke out. Technical analysts call it a cup and handle pattern. It's one of the most reliable continuation patterns. When it appears on daily charts, it's significant. On weekly charts, it's powerful. But when it appears on monthly charts spanning 40 years, it's generational. Dr. Mitchell had written 3 papers on this pattern. Most academics dismissed it, calling it astrology rather than economics. But the pattern didn't care what they thought. It was completing anyway. The handle had formed in 2024, a consolidation period after breakout, silver oscillating between $50 and $60 to build energy. Then, late 2024 and early 2025, the explosion happened. 60 to 70, 70 to 80, briefly touching $83. Now, everyone was worried about Friday's rebalancing, about the drop to $70 or $65. Dr. Mitchell wasn't worried at all. She opened another chart, the gold to silver ratio. It measured how many ounces of silver you needed to buy 1 ounce of gold. In April 2020, that number exceeded 100. 100 ounces of silver for 1 ounce of gold. That was a historical extreme, meaning silver was massively undervalued relative to its monetary cousin. But since then, the ratio had been collapsing, 100 to 90, to 80, to 70, now sitting below 60. She ran regression analysis. The trend line was clear. This ratio was heading much lower. Historically, it typically bottomed around 15 to 1. During currency crises, sometimes even lower. With gold currently at $4,400, a 15 to 1 ratio meant silver would be priced near $300 per ounce. Even a conservative 40 to 1 ratio put silver above $100, and the mathematical momentum suggested this ratio would continue compressing for at least another year. This meant silver was outperforming gold and would continue to do so, regardless of Friday's sell-off. She switched to another analysis. M2 money supply divided by silver price. M2 measured total money in circulation, all dollars, bank deposits, cash. She put the chart on logarithmic scale to handle the massive numbers, and the picture was stark. This ratio was falling vertically, meaning silver was rising but not fast enough to keep pace with money printing. To match the 2011 ratio, when silver was at $49, silver currently needed to exceed $100 because money supply had more than doubled since then. But 2011 wasn't even the peak. The 1980 ratio was the real benchmark. To match the 1980 monetary ratio with today's M2 supply, silver would need to trade above $700 per ounce. The $700 number sounds absurd until you understand what it represents. Not that silver will go to 700, but that the dollar has debased to that degree since 1980. Silver, at $78, isn't expensive. It's still trying to catch up to 4 decades of monetary expansion. She began drafting her weekly note to clients, ultra-high net worth individuals, family offices, people who paid for strategic analysis rather than trading tips. She wrote, "Regarding Friday's anticipated volatility, the forced selling from BCOM rebalancing represents a tactical event within a strategic bull market." She paused, choosing words carefully. The $14 billion in notional selling pressure is significant over a 5-day window, but trivial compared to the structural forces driving precious metals higher. She listed those forces. Accelerating global currency debasement, Fed trapped between inflation and recession, BRICS de-dollarization process, inelastic industrial silver demand, physical supply tightening in delivery markets, geopolitical instability requiring safe havens, and most importantly, the completion of the 40-year pattern. She continued, "A decline to $70 or even $65 would represent a 10 to 15% correction of an asset that's up 100% in 12 months and 400% in 18 months. Such corrections are mathematically normal and historically healthy." She attached a chart showing silver trading in a triangle pattern for the past 3 weeks. Friday's selling might break this triangle downward, but false breakouts typically reverse quickly, especially when driven by forced technical selling rather than fundamental weakness. The RSI had cooled from overbought above 80 to neutral around 50. This was exactly what you wanted to see in a healthy bull market. Dr. Mitchell had never sold her physical silver. She'd bought her first coins in 1985 when silver was around $6. She'd held through the 2011 peak, held through the subsequent crash, held through the doldrums of 2015, 2020, and she was still holding. Her cost basis no longer mattered. What mattered was the destination, not the route. People asked her, "When will you sell?" The answer never changed. When the monetary system stabilizes, when debt levels decline, when governments stop printing, when the ratio to M2 normalizes. In other words, probably never. She concluded the note with a final paragraph. For leveraged traders, Friday carries risk. For physical holders, Friday offers opportunity. For long-term strategists, Friday is noise. The structural case for triple-digit silver isn't just intact, it's strengthening. She hit send and leaned back in her chair. Outside the window, Manhattan glittered. Millions of people working, trading, buying and selling paper assets. Most had no idea what was actually happening to the currency in their bank accounts. Dr. Mitchell looked at her silver position coins in vaults, bars, and insured storage. The paper market might collapse Friday. Spot price might drop 10%, even 15%. But her ounce count didn't change. Her position didn't diminish. Physical metal doesn't care about forced index selling. And when the dust settled, when the 5-day rebalancing window closed, the structural forces would still be there, pushing silver toward $100, then beyond. She glanced at the clock. Thursday evening. Less than 12 hours until markets opened. Less than 12 hours until the selling began. Somewhere, traders were panicking. Somewhere, algorithms were being adjusted. Stop losses were being set. But the 40-year pattern didn't reverse because of 5 days of forced selling. The cup had formed. The handle had confirmed. The breakout had occurred. And Friday's volatility was just the market's way of shaking out those who didn't understand the difference between price and value. Dr. Mitchell closed her terminal. She'd witnessed enough crashes, enough volatility and panic to know this too would pass. The bullish thesis remained intact. The structural forces remained present. And silver's journey toward triple digits was just beginning. Thank you for reading this analysis. If this gave you clarity while others panic, I appreciate your time. We'll see how this unfolds in the days ahead.